my fellow South African accounting students. We would like to welcome you in this Smart Cap Learning Online that is sponsored by VT Africa Holdings. I hope that your weekend was great and you really enjoyed your weekend, and I hope that you also studied what we did last week, because we did a lot of things, and I hope you are ready also for the next lesson. And don't forget that for you to participate in our online lessons, let's say if we've got an activity, don't forget that you should go to the website www.hellosmart.com and sign up as a guest, and use this ID number, class ID number 598751, and just create a clean, nice name so that you could participate. So whenever there is an activity, don't forget to go to www.hellosmart.com and sign up as a guest. Just choose any name and your class ID number, that is 598751, so that you should be able to participate in few of our activities. So today, remember last week we were doing ratios. We're doing ratios. So, but the thing is, today, Monday, I just want to go a little bit back to explain elements of, the elements of accounting, because of I could see some of the grade 12 students, they are still struggling with some of the elements. So the thing is, it won't be beneficial if you don't know what element is the sales falls under. You see, you should be knowing those things. What are assets? What are your liabilities? What is your income? How do you treat your income? And you see, so that when you go up, you should be able to cope. So we just go a little bit back. We just go back and do and speak about the elements of accounting. And remember, we'll still come back to ratios. Remember, on Friday, I think we did gross profit on sales. Yes, we did this, and also gross profit on cost of sales, and also operating profit on sales. Yes, we'll continue doing those ratios, and so that you should understand what's happening. But as we explain them, if you don't understand the elements of accounting, sometimes it will, it might, confuse you as time goes on when you learn other things. So just go a little bit back and talk about the elements of accounting. So, but just take note, study these ratios. Yes, study these ratios that we did last week. Yes, so as we continue, let's talk about the elements of accounting. We've got the elements of accounting, 5 of them, which are assets, liabilities, and income, expense, and income. So there's the elements of accounting, and you've got to know them, and you've got to know how do we treat them, and how do you define them. So sometimes, we get confused in identify maybe a certain transaction, you see, because of we like to know this. We like to know this. We ignore this, the definition of these 5 things. So we're gonna go through them a little bit, then so that you should have a clear understanding. You see how we treat these elements. So we've got assets, liabilities, income, expenses, and equity. So now we have to know the definition and how to treat them. How do we handle them? Do they increase on the debit side or on the credit side? Where do they go? Where does asset go on the income statement or statement of financial position, or does it go to the statement of changes in EC? So we're gonna go through that. So we'll start with an asset. So what is an asset? So what is an asset? An asset is a resource controlled by an entity as a result of past event and from which if future economic benefits are expected to flow to the entity. So now, when you look at something, maybe there is an item. Firstly, you have to identify it. Is it an asset or a liability? What is an asset? It must be a resource. And that resource must be controlled by an entity. Even if the entity doesn't own that. But as long as the entity has a control over it, you see, it must be to control by an entity as a result of a past event and from which future economic benefit, which could be, it could be maybe receiving rent or receiving any income, any form of income. See, any form of income. It could be maybe, but there should be benefits out of it. So the rent, it could be any form of income or interest, or it could be maybe a revaluation gain. Evaluation gain. You see, are expected to flow to the entity. See, so that is an asset. So remember, when you meet, maybe there is a transaction that says, you know, the entity ABC Limited bought a motor vehicle. First of all, when you look at that vehicle, you should firstly identify it. Is it an asset or like, is it a resource? Is it controlled by an entity? As a result of past event, it was, yes, for future economic benefit. So that vehicle, what is it going to do to the economy of the business? You see, what are the benefits from that will be derived from years. So and those benefits, they must flow to the entity that is an asset. That is the definition of an asset according to the framework. So we'll go to the next one. These are a few examples of an asset. These are a few examples of an asset. So it's quite many of them. So under property, plant and equipment, we've got a group of current assets. Remember, we spoke of non-current asset. We spoke of for this, it's non-current assets. We spoke about this. Remember that these are assets that last over 12 months of the financial year. So under property, plant and equipment, well, that's where you get like your motor vehicle, your machine, your plant, you know, maybe your trucks and your equipment, and yeah, so on and on. Your buildings, your land and building, that's where we put all those current and non-current assets under this note here. That is called property, plant and equipment. Okay, property, plant and equipment. So I hope that we are together. Remember, the definition of an asset is a resource controlled by an entity. So these are the resources controlled by an entity resulting from the past event of which future economic benefits. The benefits from this, they're gonna, sorry about that. benefits are going to flow derived from these assets. They're going to flow to the entity. Remember, assets are used to for the company to certain benefits, which will result in revenue. That there should be an income. That's the aim of a company, that there should be much revenue. So for that revenue to be there should be what assets being employed. Certain assets they will be employed. I see. And we've got what we call intangible assets. Intangible asset, it could be like a software. You see, it could be a certain program. You see, those are your intangible assets. You see, like your Microsoft, and those are your intangible assets. And also, we've got financial assets, which could be your shares, your share capital. No, it could not share capital per se, but when the company buys shares from another company, that will be your financial assets, because of if the company issued out shares, that is equity. So we've got your shares, preference shares, or it could be your ordinary shares or cumulative shares, different types of shares. And you've got also the debentures, and also we've got bonds, we've got trust, different kinds of financial assets. And we've got also investment property, whereby the company will buy a certain land or a certain property just to keep it. They could buy a certain piece of an art, or maybe gold or something, to keep it for the aim of keeping that property is that the value of that property should, as it goes up, they keep it because the value will go up, and later they will sell it because of they will have gained profit over that revaluation gain. And we've got what we call a goodwill. A goodwill is whereby, I'll make an example. Maybe I start a company, or maybe a food outlet, whereby I sell food. Then I see that now I've got a lot of customers. Then I started opening another shop somewhere else, maybe in KwaZulu-Natal. Then I see that no, it's quite demanding. So what I do is I become a franchisor. I sell my name. I sell what I've started, just a brand name. Now, when people want to start a business, they come to me, that I show them how this is how I want my business to be run, but you're gonna run it at your own, but in this manner. So that is called, a contract between a franchisor and a franchisee. We've got a lot of different types, different examples relating to that, like KFC, like McDonald's, or Engine Garage, and your fuel stations. A lot of companies, they do that, and then what they do is you as an individual, if you want to own, I'll make an example, maybe a KFC or Dibonairs, or those kind of businesses. Actually, you won't really own it. You see, they will provide you with certain skills, then they will just it will be so strict that you have to that business in a certain. So as you are running that business in a certain way, remember, if you didn't start it was started by someone. So you're gonna pay what we call royalties or goodwill. Yes, you see. Yes, and we've got also current assets. Current assets that they don't last for more than 12 months. They just last within 12 months, which are your inventories, your bank, and your trade and other receivables. That is your debtors, because they buy on credit, and they're gonna pay within maybe within that financial year. So those debts, they don't last long. So I hope it makes sense when you talk about assets. I hope now you understand what is an asset, the examples of assets, and you can go deeper in them. And I will open up activities whereby you can ask questions, and then I'll be able to answer you. And yeah, we'll take it from there. So let's move forward. Then what are liabilities? What is a liability? A liability is a present obligation. It's a present obligation arising from the past event in the settlement of which is expected to result in an outflow of the entity's resource. That is a liability. The definition of a liability. Remember this definition that I give you. It's a definition that even when you go to university, they're gonna teach you the very same definition, and they are according to the framework, and you have to write them the way they are. This is a mark. It's about 3 marks. Yes, I'm telling you, you'll pass if you start learning this. You'll get it right. So just take it as it is. The definition of a liability, also the definition of an asset, and make sure that you understand that. I see. The present obligation of the entity arising from the past event, the result of which is expected to result in an outflow of the entity's resource. Remember, a liability, it's like you're gonna owe. There is an obligation here that you have to pay. And you see, it's a present obligation of which there was a past event. Example, I'll make an example whereby you made a loan or you bought a credit. You see, that is a past event, maybe last year or 3 months ago, but you're sitting with a present obligation of which you have to pay. You see, and by paying, meaning that resources are going out. They are going out. Resources like, I'll make an example. You are paying, money is going out, money or funds are going out. Then maybe interest also is going out. Yes, see. So it's just a few examples relating to that. Let's continue. The examples of liabilities. The examples are this. About that, I just want to fix something. Yes. So examples of liabilities, we've got long-term borrowings. Just to make an example, like your house loan, bond, and maybe your car installment, and there are a lot of different kinds of long-term borrowings. And there is also other financial liabilities, and your long provisions, your deferred tax. So make sure that you pay your tax. Also, look at your current liabilities. These are just examples of liabilities. You can go on and on and on. Trade and other payables. That is your creditors, people that the company that is those creditors that the company owes. And also we've got short-term borrowings and current portion of long-term borrowings. There will be a time whereby the company will pay a certain portion of their I'll make an example whereby the company maybe makes a loan of 1 billion that it's for 10 years, but in every 3 years it pays maybe, let's see, 300,000. You see, 300,000. So that 300,000, then maybe in that year, then it's a current portion of a long-term borrowings, then it has to pay it on that particular year. So then the income tax that you have to pay, and after that, after doing your statement of profit or loss, after you've completed your income and your expenses, right there is your income tax that has to be paid. So I don't think for now you don't have to calculate this is not you don't have to really stress much on how to calculate the exactly the income relating to the financial. I think that we're gonna deal with it later. So as you'll be writing, you'll be given that this is the income tax amount, or they'll just give you a percentage, but never try to figure out how to get to calculate the the income tax amount. You see, because of it's spelled differently. When you get to university under the module called taxation. Okay, let's continue. We are now on equity. What is equity? It's any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. So it's a nice definition. Remember this definition, don't ever forget them. These definitions, you use them till you finish even your study. You see, when you go and do your accounting and your finances, and they ask you what is an equity, make sure that you use this. You'll never get it wrong. Okay. Example of equity, it's a capital contribution. Remember, a sole trader, what he'll do is he'll get a loan to start a business, and as he start a business, that is called a capital contribution. You see, and a company, what it will do is it will, also maybe get money. How does it get money? Through selling of shares, and then we call it a share capital. The share capital, and we've got what we call a retained earnings. A retained earnings is the that net profit after tax after the financial year, when we have paid even everything, and then that is the net profit down there. Then that net profit, it is taken, it is called the retained earnings, is put under the statement of changes in equity. Let's see. So let's move on. What is income? Is income increases in economic benefits. Okay, remember, it increases what? Economic benefit, number one, during the accounting period. It must be during the accounting period in that financial year, and the form of inflows or enhancement of asset. You see, as to it can be an inflow or enhancement. What is it? Enhancement? It could be this one. It could be maybe revaluation gain. Revaluation gain. That's just an example. Okay. Or decreases of liabilities that result in increases in equity other than those relating to contribution from equity participants. Remember this definition, know them, because they'll help you even to sort out a lot of things, even ratios. You'll be able to, understand a lot of things, to understand even ratios, how to do financial statement, how to even do your journals, because we'll just go through a few things about journals that you should understand. Okay, this is an examples of income. That is your services rendered, your sales, your income, your interest income, your dividends, also your revaluation gain, and it can go on and on and on. So, expenses are decreases in economic benefits during the accounting period, but during that financial period, it could be in an outflow on depletion of assets. That could be either your depreciation. I remember we used to call it a negative asset. Oh my! But you see, it's either depletions of an asset and or outflow, which it will maybe your cash flow going down. That will result in money going out of the company, but there will be an outflow. Incurrences of liabilities that result in decreases in equity. Other than those relating to distributions to equity participants. Okay, let's move on. I'll see the examples. The expenses. Okay, there's a few examples. Remember, it's not all the examples. I just listed only a few. We've got many examples. So it's just, to give you a highlight so that you should understand. Your examples, we got the cost of, your finance cost. Your finance cost, those are maybe your bank charges, your interests charge. Those are your finance costs. The insurance expenses could be your insurance expenses. It could be your maybe insurance for the building, insurance for the the company's assets, the repairs to company's assets, administrative costs. We've got many expenses. Transport costs, discount allowed, bad debts, and this is just few of example of expenses. Now, we come to this example here. How we treat this element. I hope I was very quick, but very clear. As I did take it slow so that you should understand and you should never be confused. Treatment of these elements. Assets always remain. Assets come in, they always increase on a debit side and decrease where? No, I'm sorry. Sorry about this. Sorry. I'm sorry about this one. I'm sorry about this. I wanna. Just, okay. But what I'll do is, yes. Okay, let me just remove everything here. So assets in increase on the debit side and decrease on credit side. And we come to liabilities. Remember, assets always decrease on the debit side and decrease on the credit side all the time. So with liabilities decrease on the debit side, it decrease on the debit side. Sorry. And increase on the credit side. And same thing with equity. Equity decrease on the debit side and increase on the credit side. And income decreases on the credit side and decreases on the debit side and increase on the credit side. Expenses increase on the debit side That's how it goes. You see, that's how it is. So remember, assets always increase on the debit side and decrease on the credit side. Liabilities decrease on the debit side and increase on the credit side. Increase on the debit and increase on the credit side, and income on the debit side increases on the credit side, and expense on the debit it increases on the debit side, decrease on the credit side. So please, this is a summary of how to treat these elements. So we'll make maybe one or few examples so that you should understand. Maybe making an example. Maybe with an asset, maybe we'll say, let's say we start with an example, how to treat an asset. Okay, we will say AAB Ltd bought back of you see. Remember, first you identify. First you identify. What is this? It's a what? It's an asset. Why? It's a resource. Now because of the company or this, it shows that there is a control here. There is a control. And now, since there is a control and it is bought, of which is the result in the past event, of which is going to be used for the benefit of the company. So this is an asset. So what did you say about an asset? Because there is an inflow of an asset. So we're going to do this. An asset so that you should understand. So this 300, it will increase this side. You see, it will increase. So we're gonna say 300,000. You see, remember we said what? Asset. Remember what we said? Asset increase on a debit side. You see, and decrease on a credit side. You see, on the side they increase the side. Then if it happens that maybe sold machinery for 150,000. So remember now, it's an outflow. An asset is being removed from the entity. So meaning that what will happen? This one, it will be minus. It's an asset here minus 100. You see, that's what happens when we talk about general ledger, where to debit, where to see. This is an example. So remember this kind of an example. That as time goes on, when we meet transactions, we will never go through this because we have once went through this. So I want you to understand clear, just to remind you, it's things that I think you have learned in maybe grade 10, 11, but I think it's important for us to remind ourselves in this going forward, because when they'll ask you questions that sometimes because of lack of this foundation, people, they find accounting being difficult. So let's go on. Okay, liability. Okay. I'm just making an example. So this will be the treatment. Remember, this is the liability. The present obligation whereby they receive the loan, they have to repay it. And now Since they received a loan, now there is a liability, of which you said liability increase where? The debit side, the credit side. You said they increase where? On a credit side. So meaning that there'll be a plus here. And that plus will be from maybe, let's see, a loan that is maybe, let's say, 500,000. Let's see. So it will be a plus 500,000. Yeah. Now, let's take another example. Remember, liabilities always increase on credit side. Then we come here. I will say maybe A, B, C Limited paid half of the loan. Maybe that is obviously 250. So meaning that we are making our liabilities to be low. So they decrease here. So it will be your 250 on the debit side. So liabilities, they decrease where? On the debit. So remember, we are not done. You've got what we call double entry principle. This is just to show you where do they increase and where do they decrease, you know, these elements. So we're going to show you also the double entry principle regarding when we're doing the journals. But for now, I just wanted you to understand the concept behind the this financial asset. So this is one of the examples. So remember, we are still dealing with analysis and interpretation of financial statements. But the thing is, you've got to understand these elements because of regarding this topic, those elements we're going to talk about them throughout. So we don't want you to get stuck, and then we'll continue also on. Sorry about that. Okay. We'll continue with our ratios, you know, in the format. But firstly, we've got to understand those elements very clear and proper, and still that when we do this, you should understand why, you know, because there is another ratio that is called an acid test ratio. I believe I got it somewhere here. Yeah. This ratio, you see, whereby you should be understanding why trade and other receivables and current liabilities, you know, trade and other assets with the current liabilities, and yeah, current ratio, current assets. Someone will just see it like that, current liabilities. What does it mean? You see, but you've got to understand what are those elements, and that when we come and explain this ratio, you should be, you know, having that background. What is an asset? What is a liability? What is an income? What is a statement? So if we compare current assets and current liabilities, what does it mean? You see. So we'll continue. I think on our next lesson we'll continue this. Then thereafter we want to go to maybe journals or the financial statements. So for now we'll just stop here, and make sure, please, make sure that you study, and we'll just open, maybe tomorrow we'll open an activity, but make sure that you study your work, study these things that we have learned today, and make sure that you know them. Make sure that you know these things, and may you have a good day, and may God bless you. We'll just stop right here, and we'll continue tomorrow, and come prepared. And remember, our exercises will be derived from this book. So just make sure that we get a lot of exercises from this book, because a lot of learners are using this and at their schools. So we'll try to get much exercises from this book, and then also from the past papers. So thanks. We have reached the end of our lesson, so we shall meet also tomorrow. Join us tomorrow at 12 o'clock. Thanks.